following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Mark Longo here from the Options Insider Radio Network and theoptionsinsider.com, and I'm breaking in to your regularly scheduled program to give you guys an update on our Options Insider educational series. Now, a lot of you guys have been asking us when we're going to do something else like our groundbreaking Unusual Activity Forum that we held back in May at the CBOE. Well, mark your calendars for December 7th, because we're diving right back into the educational fray with an epic event on that Saturday, December 7th. We're going to break down the retail options trading landscape with 3 seminars held in partnership with our friends over there at optionpit.com. We'll break down the key mistakes that cost retail traders real money in the real trading marketplace, as well as how to properly implement and manage and adjust some really critical strategies like debit spreads, credit spreads, collars, risk reversals, butterflies, covered calls, the whole 9 yards. And best of all, this is going to be an online event, so you can join us from the comfort of your own home in your favorite bunny slippers. Don't miss this epic educational extravaganza with 3 seminars from 3 of the leading names in the business. Reserve your seat today at theoptionsinsider.com/events. And now I'll return you to your regularly scheduled program.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the Options Insider Radio Network. Let me quickly mention here at the top of the show, again, if you haven't registered yet, a few seats left open here for the upcoming December 7th webinar we're doing with you boys over there at Option Pit. Going to break down a lot of great options topics that you really need to know today as a retail customer. The top mistakes you guys are making and how to avoid them, as well as how to manage a whole boatload of positions that I know you guys love. Credit spreads, debit spreads, flies, the whole 9 yards. If you guys really want to learn how to tweak and manage those things to your heart's content, as well as a lot of other cool stuff, then surf on over to join us there on December 7th. You can find out more at theoptionsinsider.com/events or by surfing over to the Option Pit Events tab for more information. Should be a lot of great stuff there. Also, to mention here at the top of the show, a lot of you are asking, hey, when's that Options Insider mobile app you've been talking about? When's that coming? Just found out from our developers it's going to be delayed a little bit, so hopefully maybe before the end of the year, but definitely in early Q1. I was hoping to have it out by now, but as you can imagine, the recent tweaks to iOS and to Android have caused some consternation in the developer community, and our guys are working through that as we speak. So hopefully we'll have more details on that shortly. And joining me today on the old All-Star panel, once again, we are Viceroy-less, but we'll have to soldier on nonetheless. So everyone else here on the show really has has put on our jaunty caps in solidarity with the Viceroy, hoping he can make it back to see us soon. And starting off with the man with the jauntiest cap on the show today, beaming in from the great state of Maine, the rock lobster himself, good old Andrew Giovinazzi from OptionPit.com. Mr. Andrew, welcome back to the show, sir.
Thank you for having me. I got a couple questions for you. One is, when the Viceroy is not here, we need sad music, like a sad music cue.
No, that's not bad, like a little sad trombone or something.
Exactly, like something like that. And was it the same Canadian company that helped develop the healthcare.gov website is working on your Android app?
It might be. You know, I saw they had many other things going on, and perhaps they also develop healthcare websites on the side.
Because, if you have like more than 4 people download one of the shows, I heard that your app was falling apart there.
Yes,
so didn't really have the ability.
It's well known that our audience is 4, and if you go beyond that, if you start hitting 5, forget it. All the bets are off.
No download.
Are you excited?
No download for you.
Are you excited for the big December 7th shindig, sir?
I am. I got actually I've been working on the outline of that as we speak. So, I think I'm not going to throw curveball at people, but just how I think about basically putting those trades on and managing them. That's kind of where my head will be. There's a little bit of Tusa in there, although there is some good strategy that he uses for that type of trading. So
I'm going to do nothing but curveballs.
Kind of ideas we'll be talking about. Not exactly, but along those lines.
Nothing but curveballs from me. Like, you should only pay money for credit spreads and all kinds of great little snippets like that. So stay tuned for that.
Listeners, make sure you wear your helmet.
Yes, I just blew a lot of people's minds. Speaking of blowing minds, we are also joined by the actually on time today, good old Uncle Mike Tusa. What's the matter? The clients aren't pestering you at 3:02 today, Uncle Mike?
No, I always try and get here on time. I'm never late. You guys just start early at times.
That's true. We always start at 2:55 or so, just to make it hard for you to join us on time.
That's the way it goes.
Oh, and because so many of you have requested it, we are indeed recording this on November 18th, and you're hearing it on the 19th. So a lot of you like to know the time and date we're actually recording this stuff. There you go. For your own edification. Now you're all set. You're all up to speed, and it's time to dive right on into the trading block.
The trading block.
All right, and welcome to the trading block. It was another one of those interesting days where we start the script off one way, then we kind of change it up towards the end of the day. We started off with a lot of noise coming out with S&P crossing 1,800 and the Dow crossing 16,000 and all that kind of noise, and then giving it up ever so slightly towards the end of the day. S&P closing at 1791.5 roughly, and the Dow closing about 15,976. So not too much of a give up there, but a little bit of a retracement towards the latter half of the session. We also saw a little bit of that weekend plus coming back in vol land with everyone's favorite useless indicator, the old VIX cash, ticking up about almost a full point to 13.09 today. But I think we'll start actually going back a couple of days because since our last show, of course, we recorded our last episode on the 14th, so it was Twitter Options Eve, listeners. We talked about it a lot on our most recent episode. Everyone was getting excited. Everyone was getting in the Twitter options mode, expecting a pretty big explosion of volume. And we saw something that was kind of interesting. We saw the first day on Thursday, Twitter doing pretty well. We saw pretty much it coming in line, not in terms of volume, but in terms of perhaps the breakdown. We saw about 66,000 puts and about 38,000 calls going up towards that. That's most of the day's data. I don't think that's the full day's data. I'll have to pull up the rest to get the full day's numbers. But the put call came out somewhere around 1.75 to 1. So that was not surprisingly pretty heavy on the put side. A lot of people who are underlying holders wanting to hedge. A lot of people just wanting to spec on that wild ride the stock has had so far, thinking it's going to be giving back some of that. But certainly not perhaps the day that a lot of people were hoping for. I know I talked to Alex. He couldn't make it today, but I asked him, I said, hey, any data from Twitter that you might want to share from us? And he said, yeah, it was all right, but it wasn't really, I don't think, the day a lot of people were hoping for. Everyone was looking kind of back to the last big, heavy social media IPO. That was, of course, Facebook last year. That did a record 365,000 contracts on its first day. Twitter not coming anywhere close to that, probably close to a third. So overall, not exactly perhaps the explosion of volume. Certainly a decent name and a decent day, but not perhaps the explosion of volume that a lot of people were looking for. Looking at the numbers for today, we closed today. It's been averaging about 100 and 110,000 contracts a day. And actually about 122,000 contracts a day, doing about 110,000 today, so slightly off that. And the put call overall and the overall open interest is about holding steady. It's about 2.1 to 1. So a lot of interest on the downside, on the old dark side there in Twitter. Not surprising. A lot of people looking to hedge that name. And also a lot of people looking to spec, and a lot of people just looking to get short and using the options to do that. Andrew, what's your take here from the first few days of Twitter? What are your clients saying? What's the vibe over there at Option Pit when it comes to Twitter?
Well, we had like a little, like in our strategy there, we put on a little front spread, like a broken wing butterfly. It had moved so much, we closed it down, a small amount of money, because Twitter is moving much more than we thought. So, the vibe is they're not real. Nobody really likes it as something to own at this level. We set our little broken wing flag, fairly below the market, and it kind of got there fast. So you normally, when things move that fast, I'm kind of wrong on just about everything. I thought vol would probably come in a little bit, but the first day, I think the first day pop was so big. Nobody that we have likes it. As far as, it's like, and 0%, nobody likes it. So we thought it would just drift around here and do nothing, but it's just, I think today, because they sort of sold every one of these momentum type social media stocks, it feels like, that Twitter got taken with it. But for the most part, it just looks like a stock that could kind of go down. Until they have earnings or something to justify some value, I don't see a reason to own it, that's for sure. That's why we closed our trade.
Well, the only concept of which you would want to own it is if you're buying into the greater fool theory, and that is that more people are going to think it's good after I think it's good, and I just need to get out before they get out.
Yep, and I'm not seeing that right now.
Yeah.
Yeah, unfortunately, I think a lot of those fools got in on the IPO day, and they've had their wild ride, and now they're getting out to the later fools, which would be the ones getting in now.
It's been straight down pretty much. It hasn't seen 48 or 49 again from that kind of big print that it had.
I'm surprised that you're actually surprised by the volatility out there in Twitter. You thought it was going to be kind of a more staid issue, Andrew?
Yeah, well, we looked at, it's like when you're a market maker. You used to look at how stocks, names of other, the Facebook volatility came in a little bit, LinkedIn after all some of these social media that had a big pop. They held up and the vol came in a little bit. But as soon as volatility was up like 2 points, I'm like, I'm out. I don't have any. I was expecting it to come in relatively quick and the stock not do much. It's doing the opposite of what I thought. So automatically I just get out. Take a small loss in the game. Bye-bye. So I have no
dog in that fight.
No dog in that fight. If it doesn't do what I think it should do, I assume that I'm wrong and then I go on. So
good lesson for a lot of our listeners. If you got no dog in that fight, you're just specking and it doesn't go your way. Don't be afraid to take it off. Clearly, things are not going to get better.
It's just short a little gamma and it's moving. It's moving a lot more and the vol's coming up. And you know what the thing is? Through the day, it felt like it kind of kept getting bid. So I think Mr. Tusaw on the greater fool theory here, but people are going to start buying. Maybe they start buying a lot more puts on the greater fool theory because it's just not. Let's just say it ain't going up anymore. It hasn't gone up for quite a few days now, so that's not good.
Yeah, the use case we anticipated people coming into the options for is, of course, that borrow rate in the stock was atrocious in the first week. I think in the first couple of sessions it was somewhere around 99% to borrow it, and so that came down when the options were launched, but still it was pretty high. And so in the initial days, we saw initial hours of the trading, we saw a lot of people just flocking into puts as a way to get those short positions and those hedges on. Of course, they were paying that commensurate premium, like we said on the last show, answering that listener mail. Those puts came out a little juicy, a little pricey, because they knew everyone was coming for them. And, of course, because the market makers have to pay that borrow like everybody else. So they're passing that joy along to you. So if you were one of those people flocking into puts in the beginning, you paid a hefty premium to do that. And still, that didn't dissuade a lot of people. Like I said, 66,000 puts, roughly almost double the number of calls going up on that same day. And today, like I said, today we saw about, actually it was a little bit closer to even today. We saw about 51,000 calls and about 59,000 puts, so a little bit closer. The overall open interest put call is about 2-to-1. But today was about 1.2-to-1. That's funny. It's one of the first times we talked about put call here on the show, and we actually have a question about it later. Kind of funny how that works out. We don't really hit on that often on this show. Maybe we'll get to that a little bit later. But yeah, I actually did ask Alex too. I said, what else, if anything, would you like us to mention on the show? And he said, coming back to Twitter, he said something interesting. We've been talking about the puts, obviously, but today, actually, like I just said, the calls were showing some activity. So and he said over at OX, the popular one was the D's 50s. And if you pull these up here on overall, they were just the popular name across the board with about, actually another 1,000 went up right towards the end of the session when I started writing these up. They were at 4,700. Now they're at 5,700. So quite a few D's 50s lighting up the tape today, nearly 6,000 on about, 100,000 contracts going up today. Costing talking about almost 6% of the volume just in that D60 strike alone. 2,600 open interest, so someone probably adding a substantial amount to that. Interesting. So there is at least one bull out there. I haven't looked to see. Alex said most of their stuff was buying. I'm assuming most of this is probably buying as well. Could be some overwrites out there as well. But it looks like there are at least a few, or perhaps some aggressive shorts who are stopping themselves out of the 50 strike, one way or the other. And maybe leaning a little bit more towards the latter there than the former. I have a hard time believing there are a ton of hardcore Twitter optimists out there. Who knows? Tusaw, you been playing in that D's 50 strike? Is that you?
Nah, I only do that for my big account. No, it's not me. Whenever anything goes IPO like this, I typically like to stay away for a couple weeks. I did get into Facebook right on the IPO, but we did it with such a small chunk of it that this was actually one of the times that I actually bought on the way down. And I remember that there was one guy that actually set up an account with me, and the whole purpose as to why he set up the account, he was actually a relative of a current client. He just wanted to make sure that he was in on the IPO of Facebook. So I said, okay, with this money that you have, what is this money with your financial situation? He's like, oh, this is my wedding money. I'm like, okay, when are you getting married?
Tomorrow.
And he said, oh, probably another few months. I said, all right. After speaking with him about the risks of getting in on an IPO on something like Facebook, one thing that we decided was, all right, we will take 10% of this money. I'm going to buy right at the open. Whatever Facebook is, we're taking 10% of this cash, we're getting in. And then once it goes up 10%, we'll do another 30%, and I forget what the increments were, but it was, we were going to buy on the way up because he was convinced Facebook was going to go to 6,000 or something like that. And so with that, we bought it at the open, and then about 3 or 4 months later, he sent me an email thanking me for saving his marriage and requested his money back.
Yes, that's unfortunately all too often. That's how those IPO stories play out for retail. You get caught in the wake of the big institutions who are propping these prices up at crazy levels and doing all sorts of other shenanigans behind the scenes to make these first days look attractive, so they can turn around and justify their fees and their ungodly percentages to the clients. But once that stuff happens and the smoke clears, it's usually guys like that who are trying to pay for their wedding who end up holding the ball.
He was happy as a pig in slop when he found after me pretty much strong arming him into only doing 10% at a time right off the bat. He was happy, the happiest losing client I've ever had in my life.
It's like calling you the dissuader.
I think so. I'm just
Call up Uncle Mike if you want to be talked out of a position.
You know what, though? At least you got credit for dissuading him from losing all his money.
You know? I mean, the guy was he had a very level head on his shoulders, and I'll give the guy credit. He was a great guy.
Sometimes sometimes I'm not that fortunate.
Yeah, we've all been there too.
What's that? You want to buy Tesla upside calls? Call Uncle Mike. He'll dissuade
you. There you go.
Might be an actual good use case for you, Uncle Mike. You spend a lot of time doing that, I would think.
RCM, we talk you out of stupid trades.
But you know what? That's not bad, actually. That's not a bad slogan. we talk you out of losing all your money. But sometimes somebody can be dead set on it, though.
It's a rough gig when you sometimes get paid per transaction, but still, at the end of the day, you're doing a service to your fellow man, and that's a worthwhile thing, sir.
Thankfully, we're not paid that way.
Yes, other stuff going on today. We still have a few earnings filtering out there. We got Home Depot coming out tomorrow before the open. They closed today at $79.67. Just pulling up the old Nove. Actually, let's forget. Actually, yeah, let's go to the weeklies and look at the Nove 80 straddle going out at about 240 or so. Not bad overall. I'm not a big trader of Home Depot, so I'll have to look here and see. I hate to even quote a vol number for a weekly because that's all sorts of wrong, but that does come in at an implied vol of about 36. I actually thought it might be a little bit more, but Home Depot not exactly been lighting up the old tape of late. Any of your clients playing out here, Mr. Andrew?
In Home Depot, no. We have nobody really playing, although there was some size that went up here in January. Looks like a risk reversal, selling a call or call spread. Or what is it? Selling the 80s and buying the 82.5s. But no, nobody's playing in Home Depot that I know of. And a lot of these little cheapy, I have to say, a lot of these cheapy little straddles, have been coming back to bite people in the bum if they sell them. So you got to be, a little careful. Well, actually, a lot careful with some of these things. Home Depot's an $80 stock, and I think it's up huge for the year. So just because you think it's a quiet little stock, they have been making some pretty solid moves, looking at Cisco and some of these other names. So I just you got to be a little leery here. Yeah, the stock was at $64. So, this thing's up a lot of money this year for a huge company like Home Depot, like a retailer.
Yeah, looking at that 82 half, that's got to be someone rolling. He's got about 19,000 open on the 80s, and there's nothing really open on the 82 half. So he's taking about half of it and rolling it up, it seems like. Unless he's really, really gung-ho for that $2 spread.
Yeah, he's taking his money and hitting the road.
Got to have that $2 spread. Got to have it.
All right.
Another Tusaw $2 puts, a Tusaw $2 call stupid? Is that what I'm seeing here, Uncle Mike?
No.
You caught me.
I know you like them tight, but that's pretty tight even for you, sir. All right, other things going on tonight. There was actually some news in VIX land today. I know that you guys love this stuff. Senior Andrew. Of course, we talked earlier, probably about close to a month ago now. When was the risk management conference in Portugal? Maybe about a month and a half. That's where they announced the VIX short-term index. Of course, it was still one of those kind of proprietary things they were disseminating. I think it was only once a day, so it really was of little utility to the traders. Now they've updated it. They announced today they've updated that VXST to disseminating every 15 seconds. So a little bit more useful from an intraday trading perspective. So that'll lead the way towards that actually becoming useful for people, as opposed to one of these still useless once a day abstract numbers. So if you were excited about this VXXT and the potential it may have, then they're taking the baby steps towards making it something you can actually utilize in your own portfolio. And your clients up in arms are excited about this short-term VIX. It does tie in a lot with the weeklies. I'm assuming a lot of your clients are playing in the weeklies these days.
If you're talking to me, yes. And it can be because the VIX doesn't really have any weekly. It just has the term. So, you use SPY, mostly SPY for a proxy for the weekly stuff. But yes, are people excited? They might be a little excited that what this could do for making obviously interesting trading. But just to remind everybody, the VIX trades off the different futures and time spreads and all kinds of things like that, where you might have like ARB short-term versus long-term. And a product like the VIX can be especially, let's just say it could be problematic sometimes when that in front month goes kablooey versus some of the other months. So yeah, we are waiting for it. We'll see how it shakes out. For the most part, we're still using VIX and VXX and all those other products that are reliably crappy.
Speaking of things being predictably crappy and having some term structure issues out there in VIX. Our friends over there at Barron's are finally picking up what we've been laying down here on the show for quite a while, that the ETFs and ETPs for VIX are, as you just said, predictably crappy. Big article today, I'm not sure if you guys saw it over there at Barron's. The volatility index is up, ETNs are down, what gives? And apparently they're having a big ETF summit over there at Barron's, and that's kind of how they got onto this. This is by our buddy Brendan Conway over there. Used to do the options column over there at Wall Street Journal, now doing some of the fund and ETF analysis over here at Barron's. And he quotes a bunch of different people looking at different stuff. But essentially he's saying, hey, these funds are waking up to the roll risk out here in these names. He even profiled one investment group guy who's kind of saying, he says, I examined one in particular, and he looks like you lose about 14% a month in market volatility if it were to stay still. And he starts, illuminating all of the roll risk we talked about before with the long-dated futures contracts trading much higher than the near-term contract. As you're rebalancing every day, that's going to cost you a lot. And his analysis was that it's about 14%. So you have to make that up just to kind of break even on that name. He also said that they told him when he contacted the ETFs that the average investor holding period for VXX is 1 day. So
which it should be.
Yeah, I mean it rebalances, so that kind of makes sense.
It's a great 1 day product. That's what makes it so good. It is not a 1 month product.
Yeah, exactly. And that's unfortunately the use case. I think a lot of people are actually thinking of it as, it's this great way to spec nearer term on VIX and what I think the trend is going to be. But this guy is saying, hey, if you see vol, it's low and you want to hedge with VXX, that's not, or spec on VXX. Clearly not the way. So it's nice. We obviously been beating this drum for a long time, but it's nice to see Barron's and others starting to pick it up and run with it and saying, wait a minute, why does this thing suck?
But that's the value of like these kind of little alternative media things. You get, a little bit more varied information than you do waiting for people just to pick it up on the sort of, we'll call it the old school mainstream type media sources.
Yes, we were cool before the cool kids got into the VXX and the ETP realm for VIX. So there you go.
Something like that.
Right,
yes.
We were cool first.
All right, and Uncle Mike, and we always talk to you guys about Apple and GLD and all the other stuff you guys have cooking. What else is cooking in the RCM portfolio these days? What other option strategery are you working on behalf of your clients?
Well, a couple things, actually. What we've been doing over the course of the last few months, and I'm going to talk a lot more about this in the coming year, we've actually had a system with which we've started on weekly options with the Russell 2000. And one thing with which we've been I hate to say the word hesitant to bring it out, but if we talk about it too much, what's going to happen is we don't want a lot of people just selling call spreads on the weeklies and thinking that, we have an 80% chance of it making money, so let's just do this every week and make money. So we're very cautious about when we do it, how we do it, why we do it, and that type of thing. But basically, like a trade that I got into today, short the November front week, 1100 put on the Russell 2000, and then long the December week 1, so 2 weeks further out, 1080 put on the Russell, and we got in at a debit of 185. Now, we have our rules of when we get in, when we get out, that type of thing. But the point with which I want to emphasize on this is that this is something that when we are in a trade like this, I don't leave my computer. I struggle to – this is one of those BBI days, as Mark would be so eloquently referred to. So with this, one thing that I want to emphasize is that if you are doing weeklies, respect the gamma, respect the gamma, respect the gamma. If it starts going against you, you got to get out of these things quickly, whether you're doing it in such a way with which we are to make it long Vega, or whether you're doing some type of a credit spread, or if you're just being naked, whatever the case may be, respect the gamma.
I don't know about you, Uncle Mike, but I'm being naked right now as we record the show. It makes it a much more free and loose experience, I find.
Well, I thought you were talking about the options in terms of being naked. Well, never mind.
I'm always naked in my options, too. You know me. You know how I trade. Swing for the fences or go home. What's the point? Hedging, ratios, what's this nonsense?
Yeah, just buy out of the money calls. Have a hunch, bet a bunch. That's what I always say.
All right. Speaking of nonsense, it's time to put on your fedoras, listeners, because it's time once again for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. Hope you got your funky hats in hand and ready to go, because it is time once again for the Odd Block. This is, of course, a portion of the show where we break down some of the intriguing, bizarre, and just downright weird paper we've been seeing in the options market. Going to kick things off, actually, with a review, a continuation, if you will, of what we were talking about on our last show. If you remember from our last episode, Mark and I were chatting about some weird paper going up in Tile Shop Holdings. That was ticker symbol TTS. They were getting clipped last week. Remember, we record on Mondays and Thursdays. This was, of course, on Thursday's show. They were getting crushed that day. They were down about $7.95 to $13.27 on that day. And yet we saw someone flocking in to the no 15s. Remember, this is last Thursday, so these things literally had one session to go. And they bought, 2,000 plus, 2,600 of these no 15 calls for prices around 70 cents. So these were extremely expensive one-day options to be buying. And we kind of spec'd about what this guy might be up to. If it was an outright spec, it seemed seemed very near term. Obviously, it also seemed a little pricey. It seemed a lot to be rolling the dice for a one-day spec in this name. It probably made a little bit more sense if this guy was worried about a near-term correction for some short stock. I still think doing it one day, you have to be really, really nervous about a bounce the next day in order to be wasting all this money on a one-day option, essentially. And so fast forward now to Monday. This is November 18th. We can look back with hindsight, see how these options, these trades turned out. And it was a wild couple of days for TTS after we recorded that show. We saw on the 14th, when we actually finished talking about it, it was closed at $12.95. And the next day, on the 15th, last Friday, it closed at $14.50. So this guy was obviously on the right track. He was worried about a pop back, and it did pop back aggressively. I mean, it got down, I think, somewhere around the 10 handle at one point that session before closing at $14.50. So this thing had a wild ride. It was all over the place. Gaps up, but it doesn't gap up enough. Closes at $14.50. So how about that, Mr. Andrew, our friend, so concerned about a pullback. He gets it, but just not enough to really make those options worthwhile.
Looks like he's buying the wrong options. That was now it's trading 16.32. So
yeah, exactly. That just rubs salt in the wound. He was off by a day. TTS closing today, $16.32. So he was completely right. It moved exactly in the direction. Even paying 70 cents for those calls, he would have made money if he had just bought a weekly as opposed to the one-day option. So there we go. That one kind of rubbed us wrong on the show last week. I wanted to kind of see how this guy was doing. He didn't have any chance to get out of those at all. I mean, if he did, maybe he got him out for a dime, maybe tried to keep some of that money, but I don't see any signs of that happening towards the end of the session on Friday. It's like he ate all of that. We do see some positioning today in the 17 halves. We see about 1,300 of the D 17 halves going up today, 1,000 of the Jan 17 halves, or 1,100 or so. So this could be our friend taking another swing at the bat. We also see the May 17 halves going up 1,800 times. Of course, given the fact that he just piled into a daily option, I don't think he's rolling out to May. Maybe he learned his lesson. I don't know. But either way, this is just a great example of someone. I'll have to see how many exactly he did and what prices he got. So the prices are all over the board. But this guy blowing a lot of money on one day's worth of upside hedge/spec, and not exactly working out in his favor.
No, it didn't. I was like, wow, that's that's the time when you buy call spreads, where it's so expensive to buy one option. If you're going to speculate like that, just try to buy a call spread. You'll spend a lot less money, but you have a much better chance of making any on the trade. Just hopefully that's kind of stuff you're going to learn on on December 7th. But that's the idea. You got to limit it somehow when the volatility is so high. Even if you're right on direction, you could still be wrong on.
Yeah.
Can still be wrong.
This is crazy.
That's a problem.
Uncle Mike, I know this isn't up your alley. Can you think of any scenario where you would gobble up some daily calls like that?
Desperation. I mean, there's no reason for that unless you're really taking a shot. And this is just a small amount of spec money for you. That's the only reason with which I could ever possibly think of it. When options are priced that high, God invented spreads for a reason. Use them.
I did track down this trader behind the scenes, and he told me he was using his wedding money to speculate here on TTS. So I guess he didn't have you holding his hand anymore, Uncle Mike, and that's
looks
what
like
happened.
they make the weddings at Mickey D's.
Yeah, exactly.
Or looks like he really didn't want to get married after all.
Yeah, you're right.
One way to do it.
I'm not liking this chick. How can I postpone this even further? Oh, let's put it all into some daily calls. That'll do it.
Spend the money.
All right, moving on there. Actually, kind of a related name, at least from a title perspective. We're talking about Darling International. So moving on from Broken Wedding Dreams to Darling International. Ticker symbol DAR. They closed today $21.46. This is the name that does, let's see, about 2,500 contracts a day. So certainly not the lightest name we've profiled in the odd block, but certainly not the heaviest either. But they were lighting up the tape today, doing nearly 120,000 contracts. So just all over the place, 50x their ADV. So something was cooking here in DAR today. And what we saw was out in Jan, the Jan 17 half, 22 half put spread going up 80. I love these numbers. 80,000 by 39,000 times for 25 cents and $2.30 respectively. Now, here's where it starts to make a little bit more sense. The open interest is 80,000 and 39,000 on these strikes. So clearly we got some size closing going on out here in DAR. Is that your take as well, Senior Andrew?
Yeah, because it showed buy to close. So, but my biggest thing is I think the whoever the trader was, they kind of rode Darling down and they closed them pretty close to the bottom. So if you look at the chart of Darling today, it just kind of it opened like down a buck and a half or something like that, and it looks like this trade got closed at the bottom and it shot right back up again.
This is a savvy fellow.
Done too well over the last 3 weeks.
This reeks of the old put one by two, and like I said, this guy closing it out having fairly decent timing here. Looking at the chart.
Well, the problem with the timing was I think he was trying to buy back his 230s. I mean, because they both showed buy. I can't believe that it was somebody shorted both those puts and then closed them. It had to be a ratio.
It's got to be a 1x2. It's got to be a 1x2. That's why, again, those time code things, I just throw them out the window. They're so useless.
But
unless it's the two saw,
they closed it at a bad time.
Unless it's the two saw 1x2 put stupid, that might be. Two saw, are you playing in Darling International as well these days?
Okay, I never do stupids on a ratio. That would just be
That's
ridiculous.
just double stupid.
That would be really stupid.
That's crazy stupid.
Yes.
But yeah, I'm with you, Andrew. There's no way I buy that this guy is closing out some sort of ratio stupid. That would be something. That would certainly be unusual. This trade is unusual by itself, but doing it on a ratio stupid is just doubly stupid. But either way, interesting. This reeks to me of a 1x2. Either way, just some ridiculous size.
It's just all bad prices too.
Yeah,
whatever he traded it for is, the only thing I can think of is he had to buy the one and sold the two, and he closed it. He would have closed it at really good prices today if that's what he did, but it was really hard from the way the paper went up on the tape to tell that.
I'll give him the benefit of the doubt and say he's on the savvier end of the spectrum, and he got some good fills. Unless he's doing that ratio stupid, then all savvy bets are off.
And all savvy bets are done.
All right, and we're going to wrap it up today, listeners, with Kindred Healthcare, ticker symbol KND, another odd block newcomer, I believe. This one closing today at $15.29. This is the name that does a whopping 136 contracts a day, doing about 2,200 today. And what we saw, really pretty much all of the action to speak of, all about 2,100 of those contracts, all coming in the Feb 15 calls. We saw a big block of them, essentially, like I said, 2,095 going up for $1. Looks like paper came in and hit the bid early in the day, and then actually maybe it wasn't a block. It was a couple of chunks because they posted the rest at a little bit more favorable price. Either way, some interesting positioning. Looks like your standard buy writer out here in Kindred. Not surprising, a name that's very light like this. Someone looking to light up some income here. Also interesting, looking at the open interest. Looks like we got a 12.5 time spread going Feb-May, so about the same size. So maybe it's our same friend legging into another side of his trade.
Feb-May. Oh, just looking at what's the some open interest already.
Yeah, the only open interest to speak of in this name.
Yeah, there isn't a whole lot. It just looks like, okay, the stock's trading close to 1 year highs. They get in their head, I'm going to sell these calls for $1. They hit the bid, they post the offer, and the stock climbs through the day. Actually, at one point, I think the stock was trading like 15.58. So they were only 42 cents, or they were almost parity options. I mean, they're 42 cents away from that. So just crushed the volatility in them, obviously. But that's what it looks like. They posted $1 offer, then slowly they started trading in chunks as the stock moved up, and somebody basically has a very, very, very cheap backspread on their hands through February. The decay on it after those, they hedged it's probably nothing. So a nice looking trade for the liquidity providers as well, looks like. But the guy got his calls off for $1, and now they're trading higher. So
that's what happens when you do 2,000 contracts in a name that trades 100 a day.
Very difficult to get anything.
Yes. And difficult for the market makers to survive in those things, too. So that's a difficult environment for all involved. Glad to see at least some people seem to be faring well. We'll see. Interesting trades going up out there in Kindred. Maybe we'll keep an eye on that one for some future trading as well. But that's all the time we have in the old fancy hat segment. Now we're going to keep on rolling right on into the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the mail block. This is, of course, my favorite part of the show because it shuts up Andrew and Mike, really. That's all that matters. No, I'm just kidding. Of course, this is the portion of the show where you guys get to sound off and make your voices heard. If you want to join your fellow listeners here on the old mail block, you can post a comment on theoptionsinsider.com. Of course, you can find us on twitter.com/options, facebook.com/theoptionsinsider, or even email questions@theoptionsinsider.com. Just be sure to let us know which show you're referring to there in the subject line so we can route your question accordingly. Not seeing, I don't know what it is, we don't see a lot of the questions coming in from Facebook. A lot of the other mediums, people use them a lot. Maybe just for whatever reason, the housewives and teenagers demographic that uses Facebook, perhaps not sending in questions for the show. I don't know what it is. But if you're out there on Facebook, let us know you exist from a questions perspective. We get a lot of other questions from a lot of other media out there, but none from, or other platforms, I should say. But for some reason, Facebook not doing it. So if you guys are on Facebook, you're listening to the show, Facebook message us, notify us, whatever you want to do. Send us a question, post a comment on a post on Facebook. Let us know. Send your questions in via Facebook so we can see what you guys are thinking as well, even though we love all you Twitter folks and email and comment folks and everything else too. All your questions are weighed the same. Today's actually comes in from Twitter. It's a guy, BROB, I suppose he goes by. And he actually has a timely question. He says, what do you guys think of put-call ratios? I never hear you mention them on the show. Is it a useful tool or an overhyped indicator? Well, Mr. BROB, I said your question is timely because we did discuss put-call ratios at the top of the show. And you're right. This is one of the few times we've really discussed that in any sort of detail here on the show. And it is interesting because we do the odd block all the time, and yet we don't really go that way. And I think a lot of the reason behind it, at least for me, I'll let these other two guys speak for themselves, but at least for me, I tend to fall somewhere in the middle on that spectrum you put out there of useful tool versus overhyped indicator. It has some value, clearly. Looking at some things like Twitter is kind of interesting overall. I don't put much more stock in it beyond that because, quite frankly, listen to all the things we talked about on this show, different use cases and things that could skew that indicator. People look at that indicator and say, oh, the put call is 7-1. Clearly that's bearish. And there is a lot of truth to that, certainly, but there's a lot of other things that could go on in a particular name that could skew that. You could have a lot of underlying holders who are just hedging with puts. Clearly those people are still bullish. They're lighting up the tape with puts, but they're still bullish. So looking at that and saying, well, this sentiment overall in this name is clearly bearish because the put call ratio is high. Not really the case. We've also seen people, like I said, doing options tied to stock and a lot of other things. You know, they could have other legs on in other names that you're not seeing, and you're just seeing the one leg on in that particular name. So the reason why I tend to fall somewhere in the middle on that spectrum is because we've outlined so many different reasons on this show in the past that volume could be slightly misleading, could be slightly underwhelming, could be not really signaling the true intent of the actual trader. And that's on a per trade basis. When you take it all together in the aggregate, like the put call indicator does, then it's even less reliable, I think. And then when you start looking at it that way, you start saying, wait a minute, what are these individual trades doing? What is that trade doing? Certainly, I take it into account in my analysis. I will look at it and say, okay, there's this number, the number is 2.5x or whatever the case may be. Then I'll dig and I'll say, what does that actually mean? And that's what I think the real use case is. It's a starting place for your analysis, but by no means do I look at the put call indicator and say, oh God, clearly everyone's bearish on this name, because I know better. And hopefully if you've been listening to this show by now, you too know better, and you know that the put call ratio, not exactly the end all be all when it comes to sentiment analysis. Mr. Tusaw, what say you? I know you like a lot of technical analysis. What's your take on the old put-call ratio, and when or if do you actually use it?
I can't say as I actually ever use it, but I do look at it from time to time. One thing that I think it would, maybe not necessarily that ratio itself, but I guess I'm weird. I'm old school. I like to look at every individual option. But one thing that I would mention on the put-call ratio, let's say that I guess this is kind of maybe a side point to the put-call ratio. Let's say that you're typically bullish on stocks and you like to sell put spreads out of the money. One thing that I would encourage you to do is occasionally look at doing a call spread with the same strikes and see if you can get a better bang for your buck doing that. Now, I know that you're thinking, well, wait a minute, why would I want to buy a debit spread when I can sell a credit spread? I actually get paid to sell a credit spread. I'll let Sebastian and Giovinazzi jump on that bandwagon, and they do a much better job of explaining that than me, and they're absolutely right in how they do that. Their soapbox is much bigger for that avenue. But with that being said, I just know that a few months back, a few things that I was doing, and this happens from time to time, I typically prefer puts a lot of times for some of the premium selling with which I'm doing. But there's times that I'm going to just create a synthetic call spread similar to what my put spread would be because of the fact that the calls are giving me a better deal. Not by a lot, but maybe a penny or two typically. But if you're trading instruments that have a lot of liquidity on it, I would encourage you to do that. So in terms of the put call ratio in and of itself, not something that I look at. But if there's a lot more volume or volatility or something along those lines with puts as opposed to calls or vice versa, I would encourage everybody out there to look at that. And that's a topic called synthetics. And it's something you need to have a very good understanding of if you plan on trading.
Yeah, another good example of the types of volume that could be distortive and can make the put-call ratio out of whack to what the actual intent is of the end user. Mr. Giovinazzi, take us home. What's your take on the old put-call ratio?
What is my take on that? I kind of like what you said. It's sort of somewhere in the middle. Where I think it's useful is at an extreme. Like when the market's cracking up, like everybody's buying puts, you look at it maybe as a contraindicator. On a daily basis, probably not so much. I think it only becomes useful maybe more like a contraindicator on an extreme move. Basically like, what's an indicator for the bottom? Oh, okay, well, we traded about 5 times more puts than normal today. That's probably getting close to the bottom. Is it a lock for that? No, but for the most part, that's how I just use any kind of indicator. I just wait till it gets to some ridiculous level. Then you're like, okay, well, this might be useful now. But day to day, I don't think it has tremendous value. For a lot of what Mike just described, people could be trading the exact same trade on both sides of the market. When I mean sides of the market, one side of the market's the calls, one side of the market's puts. So it can be very distorting. I think what's more important really is volatility moving the volume or volume moving the volatility somewhere. where traders are really expecting like a bigger type move. The only other time I'd say put call might be interesting is in a stock that's hard to borrow, and you're trying to gauge on if the name is going to get harder to borrow or not, and there might be some more expansion in put premium. But other than that, it has some value sometimes, but I would only say in the extreme cases. Or like we'll look at put call ratios, let's say in silver or gold when they were really crazy, right? Just all of a sudden calls trading, and then they kind of stopped, and people started buying puts again. So only really when you have some sort of key. I don't know, a big change in inflection or something like that is probably where it makes a difference.
There you go, Mr. BROB, our collective take on put call. I guess you can call it a resounding meh. We're not really super keen on it, but we don't hate it. And it has its uses in certain scenarios. As long as you know what those scenarios are and how to utilize it properly, then it could be one of many tools in your arsenal. All right, that's going to do it for the mail block for this week. And now we're going to keep on rolling right on into our final segment, Around the Block.
Around the Block.
All right, everybody, those car horns mean that it is time for our final segment, Around the Block. This is where we prognosticate wildly and perhaps irresponsibly on what's going to be coming up the week ahead in the marketplace and really what we're watching for the next few sessions. I mentioned at the top of the show here, we got Home Depot, one of the bigger earnings coming out tomorrow before the open. I said that Nove 80 weekly straddle pricing in about a 3% move. We'll see if how that shakes out before the open tomorrow. If it follows the suit of pretty much every other earnings this quarter except for Google, then the buyers of that straddle are going to be hurting come tomorrow morning. But you never know. Home Depot could be the surprise that's lurking out there in the marketplace. What other surprises are you guys watching for in the marketplace? Starting off with you, Mr. Tusaw. What are you keeping your eye on this week?
Just the numbers. I want to see what 1800 can be with the SPX. It's something that's definitely has got my attention. It was teasing me a little bit today, but nothing to come avail to it.
So once you hit that level, of course, you'll be looking at the put-call ratio out there in the SPX, correct?
No, I'll just retire because there's nothing else to do.
Yes, exactly. All right, and Mr. Andrew, what are you watching for the rest of this week, sir?
Just real simply, how high can the market go? I think the market made its number. I think the SPY traded 180. I don't know if I didn't see the SPX. It looks like it crossed that line though, right? 1800.
Yeah, it did cross, but it came right back.
Right. But it's one of those things. It made the number, and now who knows what's going to happen, right? But it did hit it once. Then all the sell orders come in. What I'm kind of is just, how does the market? I keep thinking that the market is kind of priced in the fact that the taper and all that other good old fashioned stuff that was kind of moving markets at the beginning of the year. To the extent that it's priced in now and the market kind of sold off a little bit on some more hawkish comments. Hawkish meaning that the economy is actually doing pretty good and the Fed doesn't have to buy any bonds. In the old days, that was like 5%, 6% down in the S&P 500 at the beginning of the year, or I guess in the summertime. So we'll see if that translates now to the market getting smacked around. So that's, one of the main really just looking at it to see if we really go anywhere. And the fact that we got such crazy premium in VIX futures, or pretty expensive, I should say. I know we have a low VIX cash, but, the market feels like it's trying to set up for something a little bit, but it could be a meh, essentially. So that's about it. Not doing a whole lot at this level, to be honest. Writing a lot of calls against stock. I'm doing the Tusaw thing. There never has been a greater time to sell stock than today.
I've heard that somewhere before.
Yeah. So
There we go.
I forgot to mention that today.
Selling more call.
Cashing in on that Tusaw wisdom. All right, and with that, that's all the time we have. Let me check in really quickly with each of my cohorts, my partners in crime, see what they have cooking. Mr. Andrew, I think I know what you may have cooking on a little day that may live in infamy, a.k.a. December 7th.
Yes, as hopefully it will not do as much damage as that day.
Yes, we will endeavor not to destroy Pearl Harbor in the process.
We will try not to. But Yes, we will be having our option conference, and Mark will talk all about it. But I think it's a very good, it's an excellent way to sort of use options, sort of more like the way they are designed, and not maybe some crazy, hopeless speculative instruments that will cause you pain and discomfort.
Yes. So this guy who bought all those calls today, he maybe should listen or should have signed up for our webinar. He would know better.
It would have probably saved him, $40,000. But hey, whatever.
Who are we to say?
What are we to say?
All right, sir. And Mr. Tusaw, what is cooking in the land of RCM?
We have a special guest speaker coming up this Thursday night, Mr. Mark Sebastian. We're excited to have him, and make sure you tune in.
That guy's all over the place. He's doing webinars with me. He's dragging you into webinars. Crazy, crazy business. He's a webinar fiend, those guys over there at Option Pit. But indeed, yes, Andrew mentioned it. You probably heard the little promo there at the top of the show as well. We are doing our educational series is continuing here in December, so if you haven't signed up for that, surf on over to theoptionsinsider.com/events. A lot of you guys wrote in back after our big unusual activity forum that we had at the CBOE a few months ago and said, hey, I would have loved to go to that, but I'm in Colombia or I'm in Canada. I can't make it to this. What do you guys have for me? Well, here we go. You have our online streaming event that you guys can participate from the comfort of your own home, as our viceroy likes to say, in your own bunny slippers. So surf on over to theoptionsinsider.com/events or head on over to optionpit.com/events and claim your seat today. And on behalf of Andrew and Uncle Mike and, of course, myself and even the viceroy who couldn't make it today, I want to thank all of you guys out there in the listening audience for downloading and streaming and subscribing to this program, and, of course, for writing in with such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.